Investing ETF is simple, but tax time, not so much. In this video, I'll cover what you need to report in your tax return, common mistakes to watch out for, why adjusting your cost base matters when you sell, and how to do it properly with a comprehensive example. Let's start with the basics. All ETFs in Australia are structured as unit trust, which is the legal structure that allows investors to pool their money to invest. Investors are unit holders. They own a share of the pooled investments, not the underlying assets themselves. ETFs can hold a wide range of underlying investments like Australian shares, global equities, bond, cash, and property. As a result, they can generate different types of income, such as dividends, foreign income, interest, rental income, and capital gains when assets inside the fund are sold. ETFs themselves do not pay tax on their income. Instead, they act as flow-through vehicles. Any income they earn is directly attributed to unit holders, meaning you as an investor must report it in your tax return and pay the tax yourself. I use the word attributed because most ETFs in Australia, including Vanguard BetaShares and iShares, now operate under the Attribution Managed Investment Trust regime, or AMIT regime for short. It's a relatively new tax framework introduced by the ATO in 2016. Now, there are two key concepts. Once you understand the difference between them, you're already 80% of the way there. 1. Cash distribution. This is the actual money the ETF pays into your bank account. Depending on the fund, distributions may be paid quarterly, half-yearly, or yearly, or not at all. 2. Attributed taxable income. This is the income the ETF assigns to you for tax purposes. It can be more or less than the cash distribution you receive. For your tax return, you are required to report both the full amount and the exact type of income, exactly as shown on your Attribution Managed Investment Trust Member Annual Tax Statement. This statement, commonly referred to as the AMAA statement, is issued by the ETF provider through their unit registry such as Computershare or MUFG corporate markets and is usually available in July or August. It might look intimidating, but it's clearly labeled to show which numbers go where on your tax return. The good news is that most ETF providers report this information directly to the ATO. The best approach is to wait for your tax return to pre-fill and then cross-check with your statement to make sure the details match. Towards the bottom of this statement, you will see details about cost base adjustments, something many ETF investors mistakenly ignore. The truth is you must adjust your cost base when you sell your ETF. The best approach is to update your cost base each year and keep clear records. Why? Because if you wait until you sell the ETF, especially after 5 or 10 years, it can become a nightmare. You'll need to apply every annual cost base adjustment from the year you bought the ETF to the year you sell. And if you bought and sold different parcels over time, tracking each one properly can become a real headache. But first, why do we even need to adjust our cost base in the first place? As mentioned earlier, the AMIT regime gives ETF providers the flexibility to make a cash distribution that is different from your attributed taxable income. The difference between the two creates a need to adjust your cost base to ensure you are taxed fairly. AMAA statement shows cost base reductions if you did not pay tax on all of the distribution you received. That is, the cash distribution is more than your attributed taxable income. Lowering your cost base will increase your capital gains later, making sure you're not escaping tax. AMAA statement shows a cost base increase if you were taxed on income you didn't receive. That is, your attributed taxable income is more than the cash distribution you received. Increasing your cost base reduces your capital gains when you sell, ensuring you are not taxed twice. Now you understand the why, let's move on to the how. I'll walk you through an example step by step on how to adjust the cost base. Before we dive in, here's an important disclaimer. I'm not an accountant or tax agent, just an ETF investors who is interested in tax and doing things properly. Please double check anything I mentioned with your qualified advisor or tax professional. Now let's walk through John's investment in ETF XYZ from FY23 to FY25. Along the way, he buys more units, sells them, and receives AMAA statements each year with cost-based increases and reductions. In August 2022, John bought 100 units at $10 each. That's a total cost base of $1,000. John's AMAA statement for FY23 shows a $5 cost base increase. Note this is a gross amount, meaning it needs to be spread across all 100 units he held at the end of FY23. So the cost base increase per unit is 5 cents. His adjusted cost base per unit becomes $10.05, and his adjusted total cost base is $1,005. In February 2024, John bought another 50 units of ETF XYZ at $12 each, adding a new parcel worth $600. Then his FY24 AMAA statement shows a $10 cost base reduction. At the end of the financial year, he held 150 units, so the cost base reduction per unit is 6.67 cents. He applies this to both parcels. The new cost base of parcel 1 becomes $9.98, and the new cost base of parcel 2 becomes $11.93. In April 2025, John sold 75 units of ETF XYZ at $13 each. Using first-in, first-out method, he sold the first 75 units from parcel 1. At this point, the cost base for those units is $9.98 per unit based on prior year adjustments. Now here's the key part. Later that year, John received his FY25 AMAA statement, which shows an $8 cost base increase. So how many units should this increase apply to? Just the 75 unit he still holds at the end of the financial year, or does it include the 75 unit he sold during the year? The legislation makes it clear the adjustment is to be made just before the end of the income year or just before the time of a relevant CGT event. That means John must apply the cost base increase to both the 75 units he still has at the end of FY25 and the 75 units he sold during the year. So that's a cost base increase of about 5.3 cents per unit. He now applies that increase to both the units he sold and the units he still holds. For the 75 units he sold, his cost base goes from $9.98 to about $10.03. That means his capital gain per unit is $13 minus $10.03, which equals $2.97. Multiply that by 75 units, and John's total capital gains is $222.75. Since he held those units for more than 12 months, he qualifies for the 50% capital gains tax discount. So only half of the capital gain is added to his taxable income and taxed at his marginal tax rate. For the 75 units he still holds, he updates the cost base of each parcel. The 25 remaining units from parcel 1 now have a cost base of $10.03 per unit. The 50 units from parcel 2 goes from $11.93 to $11.98 per unit. This way, John is keeping accurate records year by year, so when it comes time to sell the rest, he will have the right cost base already worked out. It's important to keep all your AMAA statements and your cost base adjustment records because these details are not included in your tax return. They are your internal record, and you will need them to accurately calculate your capital gains when you sell your ETF units. Without them, working it out years later can be very messy and error-prone. If you found this video helpful, don't forget to like and subscribe. It really supports the channel more than you might realize. Thanks for watching. I'll see you in the next one.